Hey, it's Tom here and welcome back to the channel. So a few days ago I was scrolling through YouTube on my phone, as I like to do, looking for something to watch, and I saw a new video pop up from a channel called The Swedish Investor, and the video was titled Charlie Munger Roasting People for 5 Minutes Straight. Now, I'm a big fan of Charlie Munger, as you can probably tell by poor Charlie's almanac kind of sitting up here behind me, and I'm also quite a fan of Charlie Munger's kind of witty one-liner type answers as well. So I thought this would be a fun video to react to here on the channel. It's pretty entertaining, and there's also a lot of actually really important investment lessons in there as well. So let's get straight into it. I do hope you enjoy. If you want to watch the original video, unedited, no reaction or anything like that, that will be down in the description below as well. But without further ado, let's get straight into it, and I hope you enjoy.
Those of you who are about to enter business school or who there, I recommend you learn to do it our way, but at least until you're out of school, you have to pretend to do it their way.
People don't seem to get that point. You have any idea why, Charlie?
Warren, if people weren't so often wrong, we wouldn't be so rich.
No.
Yeah.
Now, what Charlie's getting at in those first couple of comments, the first one about business schools and the second one about people being wrong and then being so rich, Charlie Munger has commented over the years a few times on business schools, basically saying that there's a lot of economic theories and, things they say about valuation and so on that just don't make any sense to Warren and Charlie. And there's also theories like, efficient markets and modern portfolio theory that they're really not big fans of. People can get market prices wrong, and they can value businesses inappropriately. They can be buying and selling them in the market for way too high a price, or they can be buying and selling them at way too low a price. And the more people make those mistakes, the more people like Warren and Charlie are able to take advantage of that. And value investors are able to buy stocks below intrinsic value and sell above intrinsic value and so on. So that's what Charlie's getting at there.
I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings. So
Charlie's commented several times on EBITDA over the years as well. There's certain financial metrics that have a place and so on. I can really get the use of EBIT. EBITDA is one I really do struggle with, and Charlie clearly does here as well. What you're really trying to understand when you analyze a business is how much cash can be returned to shareholders over the lifetime of that business. And EBITDA, if you don't know, is earnings before interest, tax, depreciation, and amortization. So if you take off very real expenses like depreciation, you can suddenly make the earnings of the business look a lot stronger than they might be otherwise. So EBITDA has kind of gotten out of control, I would say, over the years. It's used almost everywhere, and you even have like adjusted EBITDA where people are pulling out one-off or so-called sort of one-off costs in a business and that sort of thing as well. So I'm fully on board with what Charlie Munger's getting at here. What you really want to understand is how much real cash kind of drops out of a business that can be returned to shareholders. If you're trying to, particularly in like a really capital intensive business where you're constantly replacing equipment and so on, if you exclude depreciation from a business like that, it really skews the picture. Like, depreciation is the worst kind of expense. Warren Buffett has described it as the opposite of float, like they have in the Berkshire insurance companies, where you give away all the cash up front to pay for a particular asset, and the value of that asset just declines, steadily over time. It depreciates, right? So I think that's pretty good advice from Charlie on substituting EBITDA for bullshit earnings anytime you hear that phrase.
Oh no, I'm optimistic about life. If I can be optimistic when I'm nearly dead, surely the rest of you can handle a little inflation. And of course, that's the other advice. The best way to get what you want in life is to deserve what you want. How could it be otherwise? It's not crazy enough so that the world is looking for a lot of undeserving people to reward. Everybody wants fiscal virtue, but not quite yet. They're like that guy who felt that way about sex. He was willing to give it up, but not quite yet. Well, you don't want to be like the motion picture executive in California, and they said the funeral was so large because everybody wanted to make sure he was dead. It was investment banker aided fraud. Now, not exactly novel.
And Charlie has a few pet peeves in life. One of them is compensation consultants, which I think he may comment on shortly later. He doesn't have a soft spot in his heart for investment bankers either.
Does not mean we approve of every buyback at all, though. I mean, we've seen.
No. I think some people just buy it to keep the stock up, and that, of course, is insane and immoral. But apart from that, it's fine.
That's actually quite good advice from Charlie Munger. Buybacks are a topic that gets overcomplicated. They're really straightforward if you're trying to do them rationally and create value for shareholders. If you can buy out your partners, which is all you're doing when you do a share buyback, and you can do it at attractive prices, at prices that are below what a private, informed business owner would buy shares in that business for. If you can buy it below that intrinsic value, it generates a lot of wealth for shareholders over a long period of time. If you way overpay when you're doing your share buybacks, it can destroy a lot of value over time for shareholders, and that's about all you need to know when it comes to share buybacks.
Listen to so many nonsensical cost of capital discussions that,
I've never heard an intelligent one.
yeah. Charlie's big on lowering expectations.
Absolutely. That's the way I got married. My wife lowered her expectations.
He dug himself out of that hole.
Sure, there are a lot of things in life way more important than wealth. All that said, some people do get confused. I play golf with a man. He says, "What good is health? You can't buy money with it." Well, there are a whole lot of things I don't think about. And one of them is companies that are losing $2 or $3 billion a year and going public.
People might want.
I see a lot of people kind of getting caught up in discussions about the latest cryptocurrency or latest IPO from some money-losing business, and I think it really is a good idea to do what Charlie Munger's talking about here, where it's just it's not worth spending brain power on. It can be very those companies can be very divisive, and cryptocurrencies and so on can be a very divisive topic as well. And I see a lot of people sort of cheering when some of those investments go south if they weren't on board with them, and vice versa. And it's just a kind of crazy thing to do in my book. We're all trying to sort of get to the promised land of the investment world, and we have different approaches and so on. But if you're a value investor trying to make rational decisions about buying below intrinsic value and all that sort of stuff, it's probably not worth wasting brain power on a lot of these obvious businesses that you should just be kind of discarding and focusing on simpler equations.
Counting, you can do things like they do in Italy when they have trouble with the mail. It piles up and irritates the postal employees. They just throw away a few carloads, and then everything flows smoothly thereafter.
Folks. That happened in some unnamed international country.
Yeah, Italy. The general system for money management requires people to pretend that they can do something that they can't do, and to pretend to like it when they really don't. I think that's a terrible way to spend your life, but it's very well paid.
So there's a sort of common theme through a lot of these comments with the business school approach and people being wrong, creating opportunities for Buffett and Munger. He's getting at another one here with kind of a dig at the mutual fund industry. So the average mutual fund is pretty diversified. A lot of them more or less are just the index. If you own 50 or 100 or 200 stocks or something, it's pretty hard not to get the results that basically mirror the stock market indices. They're promising clients they can beat the market when they can't, because they basically are the market. They've also got a structural disadvantage in trying to beat the market, because they're often scraping a lot of fees off the top. So kind of right off the bat, you're 1 or 2% a year kind of behind the index before you even get started. But it is very lucrative. If you can take 1 or 2% off the top of a multi-$100 million or $1 billion fund, it is pretty lucrative. But it's a weird industry that doesn't add a whole lot of value to the average investor. Most people would really be better off buying an index than paying some mutual fund manager 1% or 2% a year to basically do the same thing.
Well, I can't give you a formulaic approach because I don't use one. If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work. As Samuel Johnson said famously, I can give you an argument, but I can't give you an understanding. It's extraordinary how resistant some people are to learning anything.
He volunteered.
Another great Charlie Munger quote is that if you go through a full year without destroying one of your most strongly held beliefs or ideas, that's kind of a failed year. So I really appreciate that even though Munger's well into his 90s at this point, he's still able to keep an open mind and kind of learn new ideas and so on.
No, the board at Lubrizol did not breach its duty because we were not going to participate in the transaction if they didn't do it our way. Has anybody else got an easy question? And yet it's perfectly obvious, at least to me, that to say that derivative accounting in America is a sewer is an insult to sewage.
It's another one of Charlie Munger's pet peeves. Interestingly, Berkshire Hathaway have actually made pretty good use of derivatives over time. So whether it be selling put options to receive premiums as they look to maybe enter into positions and that sort of thing, they're actually some of the larger options traders going around. But at a higher level, at least, Munger and Buffett have described, I think Buffett in particular has described derivatives and options markets as kind of financial weapons of mass destruction, and they tend to think that humanity would probably be better as a whole if those things just didn't exist. But it is a marketplace, and particularly in the earlier days, Buffett especially was making good use of options markets to add a little bit of kind of cream on top for entering and exiting investment positions.
It's not that great a business as a business, casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking. But competency is a relative concept. And what a lot of us need, including the one speaking, what I needed to get ahead was to compete against idiots. And luckily there's a large supply. And I don't...
It reminds me of another thing Munger always says, which is to fish where the fish are when it comes to investing as well. He's spoken about investing in the early days, or for him, in like the 50s and 60s and 70s and so on, and just being able to basically flick through Moody's manuals and stumble across a company that's actually a pretty good business and it's trading at a PE of 2 or something, and you buy a position in it after kind of doing some due diligence and making sure that it's not a complete fraud or anything. And those kinds of opportunities are largely few and far between, particularly in really highly developed markets like the US. So it's no surprise that he's really backed people like Li Lu, who are going over and investing in China where there's maybe not quite as much competition. So or there's other less developed markets where there's a larger supply of idiots, I suppose, in the words of Charlie Munger.
I don't like multitasking. I see these people doing 3 things at once, and I think, God, what a terrible way that is to think. I like cryptocurrencies a lot less than you do. And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds, and you decide I can't be left out.
One
reminds me, once I asked the man who just left a large investment bank, and I said, how does your firm make its money? He said, off the top, off the bottom, off both sides, and in the middle. Well, I would rather...
That is one of the reasons that Charlie Munger is a big fan of business like Costco. It's really like a win-win-win kind of system. The customers do well because they're getting the cheapest groceries imaginable. The employees do well because the business is doing well and they're able to return some of the economies of scale to employees as well as customers. And then shareholders do well because you've got this big beast of a business that's kind of a compounding machine, and it's pretty hard to stop at the scale it's currently at. So I can certainly see what Munger's getting at there.
Throw a viper down my shirt front than hire a compensation consultant.
Potentially Charlie Munger's biggest hate is compensation consultants. Clearly, Munger and Buffett have been on compensation committees at public companies in the past as well, and they've really not enjoyed that experience. They've talked pretty negatively about it, to be honest. The CEO is hiring the board of directors, and most of the people on the board of directors require these board fees to live. Like, there's not a huge number of them that can just go off and do other things, and not collecting those board fees really doesn't matter to them because it doesn't move the needle for them that much. So when you have that kind of arrangement, there's really not a lot of challenging that goes on when CEOs are asking for a pay rise or whatever it might be. So they bring in compensation consultants, and Munger and Buffett are not a big fan of those types of people, and they see compensation as a fairly straightforward activity. You align the incentive of the management team with the needs of the shareholder, trying to grow the wealth of shareholders over time. So with some businesses, maybe it makes sense to incentivize managers on return on equity, and that's something that the Berkshire managers at various businesses, as I understand it, are incentivized on. Maybe in other types of businesses, it makes sense to incentivize the manager on having a low cost of production in a commodity business or something. But it's not that complicated of a task. You just kind of got to match it to the business that manager's operating.
I think I've offended enough people.
Right. There's 2 or 3 in the balcony.
Well, there you have it. That's my reaction to Charlie Munger roasting people for 5 minutes straight. I do hope you enjoyed it. If there's any other videos that you'd be keen to get my reaction to, definitely drop them down in the comments below. If you did enjoy the video, please hit like and also subscribe to the channel if you haven't already. But that's it from me for this one, and I'll see you in the next video. Cheers.